Hey guys, welcome to this week's Money and Investing Show, where we are going to look at how effective and accurate outlook and guidance was at the start of this year. We provided what's called a dogleg forecast, a Goldilocks scenario, and unfortunately the three bears have come home to roost. You'll see exactly as we break apart the calls that we made at the back end of 2021 and how they're panning out in the current market. Take plenty of notes, and as always, take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Thank you, Mr. Baxter, for having me on the show. What I'm going to do today is put you under the pump. We're going to go through a bit of a review. Here we are, new financial year. We're in July now, so I think it's important for us to sit down and review some of the old content that we brought to our listeners later on last year, just to see what our forecasts were and how we actually went in talking about them.
Yeah, it's always good to do a review for a number of reasons. You should do this on individual trades, on individual investment decisions, or whatever your processes are, because success leaves clues, and so too do deficiencies. And doing that post-mortem, you want to do more of what was right and less of what was wrong. So if we go back to Economic Outlook for 2022, which we actually published in mid-December, very specifically going through that, we did what we called a dogleg forecast. We had two specific scenarios. There was the Goldilocks scenario, if everything moves along in the right way and we get an economic soft landing and life is good. And then the other side of the equation, if we've got Goldilocks, well, let's talk about the three bears, and that would be the gloomier, I suppose, less golden scenario, which has proven to be almost on point with what we were expecting.
So just to run us through AB in a little more detail, we had the Goldilocks scenario where everything was okay.
Yep.
What was our forecast in the opposing argument?
So two or three of the major discussion points that we had was, one, a rise in geopolitical tensions, and the specific example we used was China and Taiwan. And whilst it wasn't, well, I suppose it still is to a lesser degree, but whilst it wasn't specifically China and Taiwan, it was obviously Russia and the Ukraine caused the global geopolitical shift that we've seen, which has created a level of uncertainty in markets. It certainly disrupted supply chains, particularly in the construction space and foods, and also in the energy sector too. So that was a really, really material pointer that we talked to as to, this changes the game if it happens. It certainly did happen in the first 2 months of the year and is still ongoing now. So far from transitory, it's a real problem. The second area was the notion of inflation gaining a toehold and continuing to grow. And we'd started to see early signs of that in the back end of last year, a little bit in the food space and to an extent in the energy space. The war in the Ukraine immediately sent energy prices, ratcheting up significantly higher. They were moving up prior to that, but that was a real catalyst given how important Russia is in terms of supplying Europe with energy.
Okay, so rising energy prices, higher inflation and geopolitical conflict. With all of that in mind, which in this case we got it right, and we'd still be doing this podcast even if we didn't. What was, in your opinion, the single biggest factor which determined that outcome, if you had to put it down to one thing?
The one thing I would put it down to is interest rates and the I guess the tardiness on the part of the central bank, definitely here in Australia, but also in the US with the Fed. And you can kind of understand to an extent, as a central banker, it's probably not the easiest job in the world. You're making a decision today which has a lagging and very, very long-lasting impact based on information that's a couple of months old. So it's sort of using the rear view mirror to make decisions real time that you can't even see the impact of for a set period of time. So it's not the easiest job, which is why those roles should go to people that have a very, very good touch with markets, and I think are also exceptionally good at communicating that view on markets too. And that deficiency, that ability to communicate to markets what their view is, I think is something that the Reserve Bank, and particularly Philip Lowe, have very, very low skill sets in. The US has been slightly different. They've very well telegraphed what they were doing. But in both cases, interest rates were moved higher. And that caught people off guard. And I don't know why, because, we were saying, for a solid,
6 months at least before that initial podcast.
Saying that rates are coming on. We got torched on social media for it. And again, this isn't a lap of honour to say how good are we got it right. Blind Freddie, if they're an economist or if they are someone that goes to a supermarket or petrol station or lives life out in the real world, would tell you that there was an inflationary problem. So you didn't need the economic data. You could see it anecdotally. So from the part of the central banks, I think the idea is to try and hold off until you have to make that move. And I guess some of the things that you'd want to see, we had obviously the war in the Ukraine and an immediate knee-jerk reaction with energy prices in particular. And the hope was, that's just transitory. It's a short-term blip in the market and then subsequently fell away. Except it didn't fall away. And so I think they were holding off on raising rates, and I can't speak for them, but I think in both cases, they were holding off on raising rates to try and give the benefit of the doubt to the economy that it was transitory. So you can understand the decision-making framework to that regard.
I guess the challenge is, though, AB, if I look in the case of Philip Lowe, I think it was only November, December last year, he was in his RBA statement saying it's transitory, it'll go away.
Yep.
We come to a point now, we fast forward 6 months later, and there's an inflation expectation at 7%. His words, not ours.
Yeah, I mean, it comes down to what your definition of transitory is. If you're looking at like a 20-year view, it probably is. But yeah, he got it wrong. And the difficulty I think he's had is accepting that he got it wrong. Even to the point where after he made that speech that rates would be on hold until 2024, he tried to almost backpedal and say that's not how the comment was made. And that does come down to communication. And in all fairness to the US Fed, Jerome Powell's done a very good job of it, and probably, even though he probably wasn't one of the better central bankers from a policy perspective, from a communications perspective, was probably Ben Bernanke, who was exceptionally good at keeping the market fully appraised of this is what we're likely to be doing, and these are the reasons why, so that, as we keep saying, literally week to week, markets hate shocks, they hate surprises, and so if you've got that ability to convey what you're going to do in good time, and there's no ambiguous wording around it, markets can handle that kind of news versus an unexpected knee-jerk reaction, which then creates volatility and then uncertainty and then can have a real serious knock-on in your economy. So, I think, if anything, both central banks were late getting to the party by a number of months, possibly because they wanted to give the economy the benefit of the doubt. And because they were late getting to the party, the initial opening hands have been quite strong in terms of higher than expected rate rises. And I think the notion of hitting the market very, very hard with a series of far stronger than expected rate rises and then tapering that off as inflation gets under control is actually quite a prudent strategy under the circumstance, because inflation has run away. It's well outside of any kind of bands that the US or Australia that use. And so you need to use a stronger tool to try and rein it back in. And we're not done with that. I mean, we said, we expected inflation to grow as a problem, and that's exactly what we have. And I think we're going to see, a couple more fairly significant interest rate rises both domestically and in the US before we start to then see that taper. The impact of that, of course, is massively dented consumer confidence and is a precursor, I think, to seeing us in what I'd probably modify our outlook as being is a drift into recession.
That's hard to hear. And I know there's going to be a lot of listeners out there, AB, which are, probably asking and begging the question as to where to from here. If we had to look at that in a little bit more detail from a markets perspective, what do you see moving forward for the next 6 or so months?
Yeah, I think it's going to be fairly painful, in all fairness. And I hate the notion, Mitch, of scaremonger marketing and saying, you need to do this and go and buy some tuna and some gold and bunker down and hope it all rides out. That's not what we're talking about here. You've got to have your eyes open and realize, where we are. And we've had, a long period of time where money has effectively been free to borrow, to all intents and purposes. So we've had runaway asset prices in the stock market, in the property market. And as a consequence of that, if you take, for example, in the US, if you look at the tech sector, those growth stocks have been on unbelievably high valuations, and they've been, let's call them the disruptors. Your Netflix, for example, that is disrupted in technology. Square or Block would be another example. It's disrupted the game as it is, and the share price has just gone ballistic on the back of it. Now, the earnings may not really be there to back up that valuation, but when money's free to borrow, you just simply borrow more, you run your business in the hope that at some point in the future that disrupting technology becomes the norm, and that's when you get paid. All of a sudden, if you have inflation, the future earnings of the business are very heavily discounted, which is what we're now seeing. Secondly, the cost of capital is significantly higher, and all of a sudden you get a shift, which we've really started to see, where all of those disruption growth type businesses have really started to feel under an awful lot of pressure, and value companies, which have been discarded as dogs with fleas for the last probably 7 or 8 years, are now again looking like the place that you want to invest, where there's real earnings, real growth, cash flow positive, dividends, exactly, and that sort of quality box is effectively ticked. And so that transition in markets, I think, is going to be something that we continue to see over the next few months. We've got an earnings season coming up not too far after when this podcast will be published. And I'm not going to go out on a limb, because I don't think I'm out on a limb when I say it. I think it's going to be an appalling earnings season. You pulled some stats, I think, this morning.
Yeah, these are probably worth sharing. So in anticipation of earnings season, a lot of companies, 130 to be exact, have come out and given some pre-announcement warnings, really is what it is. Out of those, which have either been strong negative or strong positive, there's nearly 2.2 times as many strong negatives as there are strong positives. So the outlook is not looking good whatsoever.
And it can't be unexpected. And that's a brilliant statistic to look at, because when companies come out prior to earnings and say, listen, there's trouble brewing. We talked about central banks just previously, about how important it is to be able to communicate with markets. As a CEO of a listed company, your obligation, amongst many things, is obviously to your stakeholders, and also to provide full disclosure, and having the ability to keep markets across where your expectations, or managing market expectations, is key. I always remember, this would be probably before your time, but Steve Ballmer, when he was CEO of Microsoft, was fantastic at managing. It's tough out there. They come out with a good number, but he'd always do his bit to dampen the flames around Microsoft's earnings. And it's been very well telegraphed early that things aren't going to be great. And so it can't come as an unexpected surprise to markets when companies come up with an earnings downgrade or really soggy guidance as to what the next 6 months look like.
Which we saw in Nike and Kohl's just a week or two ago as well.
Yeah,
which stock's down a lot too.
Like Nike, again, here's a stock that's been on a tear, and again, good prudent corporate management by disclosing to the market that there's some short-term pain when you do that. Your share price, no doubt, will reflect that. There's always short-term pain, but it's like anything. If you're playing for the long term, that short-term burn, just like when we train in the gym, we love that pain because the long-term benefit comes out of it. And in the same way, as a shareholder, annoyed as you may be that the shares have given something back, if it's done in a way where there's good disclosure, that does end up providing some stability in the share price over the medium and longer term, even though there's a bit of bark taken off today. Also, we talk about cautionary tales of investing over earnings dates anyway. There are strategies you use, and straddles are obviously a very good example of that, versus just buying and holding stock. So getting back to it, the earnings season, I think, it's going to be gnarly, and I think the outlook is going to be pretty bleak, and investors need to be prepared for that. And so being in the right kind of sectors to weather that storm and come out of it unscathed, or indeed profitably, is something that people right now should be lining themselves up ready for that visit to the confession booth of each of these companies as they come in.
Well, look, let's leave that to the end, because I know that's what our listeners really want to hear, is the where to and the plays, AB.
Which 4 stocks are you going to recommend for this?
Yeah, hang around right to the very last second, and we'll tell you.
Second.
Yeah,
tune in next week, and
click
we might do.
Yeah. So what about interest rates? Do you think they'll move higher through the back end of this year?
Undoubtedly, yes. And again, that's not really a bold call. It's pretty obvious when you look at the state of inflation. 8.6% in the US. I think we spoke about PPI, which is the producer price index, which was, I think at the time we covered it in the podcast, about 11.3%.
All-time high.
Yeah. And there's a lag factor of a few months, which I think we talked about in that podcast, before that filters through to consumer price. So you've got the producer making stuff, and then you've got that stuff being sent to market and then on sold through retail or whatever it may be, and then the consumer paying that price and then it getting measured. So there's usually about a 3-month lag or so. And so I'm not saying 11.3% for inflation, but the inflationary pressure, the cause of it, is still there. And in the case of the US, interest rates almost certainly continue to move higher. Maybe another decent lick. It's 0.75 last time around, which again is unusual. It's the first time for a long time that they've sort of pulled out their heavy artillery like that, and maybe another move of that order will go some way towards dampening those inflationary pressures down. But when you look at the root cause for where a lot of this inflation is coming from, the US in particular is in a really tricky situation in that you've got midterms coming up. And I think the Biden administration are going to get absolutely hosed, and rightly so. The economy is in a dreadful state. Because it's so bad with what's going on in the economy right now, everyone's forgotten to talk about the illegal immigration problem on the southern border, which is now running at around about 200,000 people per month illegally entering in the US and being allowed to stay. It's just a staggering figure.
Yeah.
And I think the Biden administration are in for a real tough time, and worse still is the prospect of what's coming over the hill with maybe the return of President Trump for another crack at it, or I think the senator in Florida is also a firm favorite to be putting his hat in the ring as well, who's a bit of a gun, to be fair.
No Kanye West anymore?
No Kanye West, just someone that is a Yale and Harvard graduate that's served in the military, that was a special forces advisor, is a lawyer, and is currently the governor, I think, or governor or senator. I think he's the governor of the state of Florida. So, there is competition there. But, parking the midterms and everything around that aside, the Biden administration's approach to the inflationary problem in the US is publicly appealing to petrochemical companies to reduce their prices, yet oil prices are a global commodity price. Number two, refiner margins are the big issue. The US hasn't built a new refinery for 30 years, and there's no plans to build a new oil refinery. So there's a constraint on supply. And whenever there's a constraint on supply and strong demand, you're going to get price hikes. It's as simple as that. It's just simple economics. And maybe, they might cover that at the old people's home when he shuffles off there at the end of this term, which is probably a better fitting place than the White House, to be quite frank. And again, that might be controversial, but look at the anecdotal evidence of what you're seeing. Please reduce your gas prices, petrol stations. The margin on petrol for a petrol station, a gas station, is 5 or 6 cents a gallon. Now,
they make all their money selling the stuff inside,
absolutely, right? It's $5.50 a gallon. So taking 5 cents off a gallon will make no difference, and it's not the cause of it. There's a bigger issue that needs to be addressed. And part of that, of course, is the environmental program that's in the US. So inflation pressure is here to stay. And don't forget, higher energy prices rubs onto everything. It's transport, it's heating or cooling, and everything, manufacturing, it's in everything. So there is a rub on for the consumer. So the US consumer's in for a really tough time. I think also, given some of the geopolitical tensions, the US is likely to refocus its efforts on supply chain. US companies looking at supply chains. There's talk in Congress at the moment. This is good legislation, I might add. So not everything in an administration is bad. There are some good things that come of it. And one of the things that I believe is being discussed there at the minute and getting approved is a reduction of foreign direct investment in China if it competes with the US national interest from an economics point of view. And so if you start seeing more investment back in the US to build stuff locally, that's good for the economy through one set of lenses, because you don't have all these supply chain shortages, but you have a higher cost of production to do that because of labor costs and things of that nature. So, on the back of that, that's also, even though it's good economically, is not so good from an inflation perspective. My bet would be, from an emerging markets perspective, Mexico, start investing in it. It's got an open border literally at the moment with the US, but from a NAFTA, from a free trade perspective, the North American free trade perspective, if Mexico, with a reasonably highly skilled and large population workforce, is able to become the US supply chain fix instead of going to China, you don't have any shipping, you've got an open border, you've already got existing trade arrangements in play, you've a skilled workforce, all of that sort of stuff is there. And that could go a long way towards having manufacturing supply chains fixed, but at a lower labor cost. So that is what my call would be from
a hot tip.
That's
good
my
one,
hot
AB.
tip. Yeah, it's not simple economics, but it kind of makes sense when you look at it like that. So higher interest rates in the US. Here for us in Australia, I think we're in for the same. Again, purely and simply because we got to the party late, and worse, unlike the US, have failed to really communicate with the broader market as to why rates have been held and where they're going. If you get something wrong, the best thing you can do is say, look, we got it wrong, it's worse than we thought, and we're going to be doing this to put it right. Because again, rather like Nike with some weaker figures, better getting that out in the open and it's dealt with than just letting it fester, and you've got this uncertainty that just continues to grow. And you've got people that are in a highly geared position that have bought into a red hot property market where they've probably borrowed arguably more than what they probably should, where their cost of borrowing is now starting to go up. And if it was just a cost of borrowing that was going up, the modeling that the bank uses to lend you, you'd go, okay, we factored in interest rates being, say, 2% higher. I think they'll go higher than that, but we factored that in already so you can afford your loan. What's probably not factored in is that broader surge in cost of living, because not only have you now got a higher rate to service on your loan, but you've also got less money to do that with, maintaining your current lifestyle by buying more, paying more for your groceries, your fuel, your electricity, and everything else that goes alongside it. So, I think a reasonably hard slowdown, and I don't think a soft landing is the term at all. A hard landing for the Aussie economy. The job market, and this is the one variable in here that's a bit different, is that we don't have high unemployment either in the US or Australia.
Full employment, right?
To all intents and purposes, which normally, if you're drifting into a recession, you'd expect to see higher unemployment. But there are specific factors for that. Number one, you saw a lot of people that were getting close to retirement age during the pandemic actually retire and move out of the job market, move out of the workforce, and just take early retirement. And they go, well, that's me done. That's a nice way of bowing out. And equally, you've also had a lack of return to the workforce from a lot of people, which in the case, not in the US because the benefit structure is very different, but here in Australia where you had things like JobKeeper and quite a number of economic stimulant measures that were brought in play, maybe to help win an election, which didn't get won, and buy voter support, but quite a generous support package to help people has really caused a reluctance for people to want to get back into the workforce. And and that may sound harsh, and if it does sound harsh, just look at the simple statistic. There are more people claiming benefit post-COVID in a full employment environment than were claiming benefit prior to. So there's the advert in or the headline in the newspapers over the weekend was that the dole queue as it stands right now could fulfill the jobs shortfall in Australia. Anyone that wants a job can have one. And yet you've still got this rump of unemployment, not because opportunity is not available. I suspect it's moving increasingly towards a decision, an active decision not to. And harsh as that may sound, when you've got a structure that, let's say, if you're unemployed versus working, and okay, if you're unemployed, you're scratching by on a very low income, I understand that, and it may not be that easy, in which case, get into the job market and you'll earn more, particularly given now that minimum wage has gone up. The challenge isn't about the benefit rate and the hourly rate that people earn. It's the fact that you might say, I'm going to have to work 40 hours a week and I'm going to earn maybe $10 an hour more than what I'm getting by doing nothing. $400 a week more through working versus not working, $10 an hour. Is that an effective marginal increase for me to want to be back in the workforce? And Australia, we need you. We need people back in the workforce. We're hiring. Most companies out there are hiring, and it's a question of just getting in and getting involved with something. And it's not just about the money; it's the positive momentum and the contribution to society that you bring is a huge, huge thing. So, I think we're going to have a continued low unemployment, but drifting into a recession with a very, very high cost of living, which is a really gnarly situation and very, very difficult from an investor's perspective to traverse. There you go, monologue over.
All right, well, let's go through that and finish off for today, AB. So considering that in that dogleg forecast, we had, unfortunately, the not so good scenario come true, and I think where we're at is pretty clear and we've spoken of many times. In markets, where are you looking right now? Short, long, hold?
I think overall, I've got a reasonably neutral to bearish outlook on the equity markets over the next few months. And again, I hate to be the prophet of doom, but the evidence I'm seeing based on the numerous cycles I've been around markets, you'd be a fool not to recognize the patterns that are there. We're going to be in a market which is neutral to slightly bearish, I think, where we might see a low of say 3,400 in the S&P, and maybe a grind higher, a very painful grind higher towards the back end of the year. And for investors that are listening to this, you think, oh well, we may as well cash out. There are opportunities within that, which I guess is the question you're asking. I think I would be long volatility. I suspect we're going to continue to see that spike high in volatility on particular news-driven events. And in fact, we have a strategy that's dedicated toward trading that very specifically. So you remove stock-specific risk. You're just saying, look, when volatility is low, I'm going to buy it. And there's going to be some form of bad news somehow, somewhere over the next month that's probably going to cause volatility to spike, and that's where I'm going to take my profit. It's not overly sophisticated, but it's actually quite a clever trap for trading these markets. And whether that's an earnings, like a major earnings downgrade or a swag of them, whether it's a firm hand from a central bank that continues to raise rates on a high level, whether it's a really sticky inflation number that's again higher and continuing to show that inflation is not transitory, it's actually rampant. Any one of those scenarios are the sorts of things that will spike volatility. Another shock to geopolitics, and any of the other crazy things that we've seen over the last few years. Another tanker getting jammed in the Suez Canal. It's beyond belief when you think.
We could see all of those realistically, especially the first three.
Yeah, any and all of those. So that gives you a spike in vol, and you pick up your 25-30% return. Got to do that a couple of times a year, and you're making some good money.
Yep.
So that's a niche strategy. It is a more sophisticated strategy. It's not your mum and dad buy and hold type approach. Outside of that, I think, given interest rates to continue to move higher, I think a short bonds, long bond yields play. TBT is something we talked about. TBT. And on these pullbacks that we see between FOMC meetings represents yet another buying opportunity to get set and enjoy the ride up higher again. And that's been almost, with tedious regularity that we've seen that trade play out over the last 6 months. Energy-wise, as always, the risk is to the upside with energy, and we've got 250 million people still in lockdown in China with COVID or COVID-related controls for their zero COVID policy. And as they're unlocked and allowed back out into normal functioning society, as much as you can describe it as that, there's a pent-up demand for about 1.5 million barrels of oil a day that hasn't been being consumed for the last 4 months. And you can only see that puts further upside pressure on oil prices. So I think very selectively looking at buying opportunities into the energy play would probably be three areas I'd be looking at for reasonably high probability trades.
What about some defensive plays in, say, utilities or healthcare, for example, AB?
Great point. And I think, there are times in the cycle we talked about, buying tech, which is not the time to do that, irrespective of valuation. Any spikes in that is an opportunity to sell that position down, I think. And I don't see that changing for between now and the back end of the year, to be perfectly honest. From a defensive perspective, boring businesses that push out widgets or distribute widgets that are essential are really good plays. So, defensive businesses, we talked about retail, possibly having quite a difficult time, which it will. It's a discretionary spend. If you're tight for money, you're maybe not going to buy sneakers this weekend or a new TV. But those staple businesses, alcohol and tobacco is a classic example of that.
Absolutely.
Economy copes up growth, people drink and smoke. Economy's booming, people drink and smoke. So it's a really good defensive area. Endeavour, we've got a trade running on at the moment.
Yeah, it's looking pretty good
which is a good exposure to that sort of business. So, there's one example. Utilities, you're quite right. If you're a distributor of power, people need electricity or gas. And if you distribute that, it's almost an inelastic demand. You get paid the clip on how many megawatts you transport or how many gigaliters of gas that you push through. Whatever the metric may be, you get paid your clip on that. And so they're quite defensive businesses, rain, hail or shine, that typically do very well. They're usually quite cash generative. They usually pay quite a high dividend. And I wouldn't advocate buying them for their dividend. I'd buy them for the stability that they offer in terms of their share price right now. Telcos, again, are another example of what are normally defensive type plays. Healthcare, late cycle play. And again, we've got some great positions running.
Merck, Pfizer. Yep.
These have all done very, very well. And again, they're both defensive and they're also exposed at the right time of the cycle. If you're sick, you're not going to go, inflation's a bit high, I'm not going to buy my essential medication today. It's a decision you have to do anyway. So in that respect, they can be quite defensive businesses. And I think having a portfolio that's orientated around that, if we were to use, say, a cricket analogy, there's a time when you're playing cricket where you want to hit the ball out of the ground, and there's a time that you just want to get the scoreboard ticking over, just keep rotating strikes, single here, single there, and that's what you're looking to do. And I think given the more challenging conditions in markets for most retail investors, let's face it, this is only the third time in, 10 or 15 years, we've had a negative year out of the ASX, a negative financial year. This is not a time to be trying to buy the 5-bagger that's going to hit the ball out of the ground. This is a time to stay safe and just keep the scoreboard ticking over. And if you can hold stocks that hold their value in a falling market, if you can hold stocks that maybe grind a little bit higher under those conditions, or in the case of the volatility or TBT type trade, are able to give you some good solid green ink based on a very rational argument, that's the kind of defensive tilt on a portfolio I think would best serve people in the current conditions. And look, we could be wrong on that, and it wouldn't be the first time, it wouldn't be the last time we were wrong. It just seems to make an awful lot of sense. And buying something that's oversold because it's cheap right now, it's cheap for a reason. And that's the fact that the clock is turning. We're moved into a new phase of economic activity. And for many people, it's the first time they've really seen a recession. And the way that things behave under those conditions are quite different. And under those conditions, if the conditions are different, can have conditions on conditions. If the economy, the way the economy is behaving has changed, you've got to have a shift in your investment strategy, assuming you want it to win under those kinds of circumstance.
Great little rundown there, AB. I tell you what, at the end of this year, we're going to have to do an analysis on this analysis every 6 months. I think let's sit down and do this.
I think it's great to do. And I mean, there's just so many opportunities out there. We've just skimmed the surface with this. And by learning how to invest properly and how to have a flexible, fluid and professional trading strategy under all market conditions, there's no reason why you can't be banking good profits over the next 6 months. Unfortunately, as you'll see from the performance of your managed fund or industry super over the last 12 months, it's been a dog of a year because typically they're buy and hold approaches. And I don't think you can blindly buy and hold in these current conditions. You've got to be more nimble. And that does present an advantage, a competitive advantage to retail investors that are savvy enough to where to put the pieces on the chessboard. And if you do that the right way, you'll make a killing.
Perfect way to put a ribbon around it, AB. Thank you very much.
My pleasure. Anytime, Mitch. There you have it, guys. Make sure you give us a review and a rating so more people can find this show, and we'll look forward to hosting you next week.